Chapter 8 looks at implementing strategies and specifically looks at finance and accounting issues. Here are the learning objectives for Chapter 8. You may pause here and read them. At this point in the process, we've come up with our business vision and mission. We've done our analysis on our external and internal environment. We've chosen our strategies, and now we're implementing them. So specifically here, we're looking at the implications from a finance and accounting perspective of implementing our strategies. Some finance and accounting issues that need to be considered are determining the capital structure, which is acquiring the needed capital or money to implement strategies. And this is often done by performing an EPS/EBIT analysis. We need to look at developing projected financial statements, which show the expected impact of our strategies and recommendations. Performing corporate valuation. In the event an offer is received or a rival firm is to be acquired, we need to understand the value of our corporation as well as those we're looking to acquire. We need to look at analyzing financial ratios and then managing initial IPOs or initial public offerings, cash levels, and corporate bonds. So the capital structure is the proportion of debt to equity that is outlined on the balance sheet. And you can perform an EPS/EBIT analysis to determine the appropriate capital structure needed. And this is really looking at, do I want to use stock, debt, or a combination of the two to finance my business or my strategy? So some basic terms. EBIT is earnings before interest and taxes, and it's also often called operating income, as you can see here on the sample income statement. EBT is earnings before taxes. Here it's called income before taxes. So this looks at our operating income plus other income plus gains or losses on financial instruments plus gains or losses on foreign currency plus interest expenses. Then we are taxed on our income before taxes, and then we get our earnings after tax or our net income. Earnings per share is calculated as our net income divided by our number of shares outstanding. And shares outstanding is really similar to the shares that we've issued, but shares issued includes treasury stock. So when we say shares outstanding, it's the shares of stock that we've issued. And then shares authorized are the number of shares a firm is able or has been approved to issue in total. So EPS/EBIT analysis is a really common way for determining whether we choose debt, stock, or a combination of the two for raising capital or money to implement strategies. And so it involves the impact that debt versus stock financing has on our earnings per share. And it is a 4-step process, which is outlined in your book. So the first thing we need to look at is some of the basic input data that we need to know. We need to know our amount of capital. So this is an example for Procter & Gamble. So here we need, these are in millions, so 5,000 million. We look at our EBIT range, our earnings before tax range. And so in this situation, Procter & Gamble is saying, look, we're going to make 10,000 to 18,000 or 18,000 million per year. We look at the interest rate that we would charge on debt, or that we would be charged on debt, which is 5%. Our tax rate, what we taxed on our EBIT is 23%. And then our stock price is $94.17. And the number of shares outstanding or number of shares that have been issued is 2,515 million. All right, so then what we do is we've come up with a table where we say, all right, here's what it would look like if we did common stock or issued stock. Here's what it would look like if we incurred debt. And here's what it would look like if we did a combination of stock and debt. In this situation, 60% stock, 40% debt. Then we also look at a pessimistic or a worst case scenario, a realistic average scenario, and an optimistic or best case scenario for each. So you can see that the EBIT, or the earnings before interest and taxes, is the same for each scenario. Pessimistic's 10,000, optimistic's 18,000. On common stock, we don't incur any interest because we're not paying any interest because we're issuing stock. You can see that with debt financing, our cost of our interest is the highest, and obviously with the combination, it's somewhere in the middle. Our earnings before tax is just your EBIT minus your interest. Then your taxes are, in this situation, it said it was 23%, so it's 23% of your EBT. So you take then your EBT, so in this case, 23% of 10,000 is 2,300, 23% of 18,000 is 4,140. So then in each situation, you take your EBIT minus your taxes, and you get your earnings after tax. For the number of shares issued row, what you're going to do is divide the capital needed. So in this situation, it's 5,000 million divided by the stock price. So in this situation, that's $994.17. And add that number to the total number of shares currently outstanding. So as you can see, we're not adding any shares here. And so you can see our number of shares outstanding is going to do the same with debt. Obviously, with common stock financing, our number of shares is going to be the highest, and then with the combination, it's going to be somewhere in the middle. And then to compute our earnings per share, we just take our earnings after tax divided by our number of shares issued, and we get our earnings per share. And then what we're trying to do in this situation is analyze where we have the highest earnings per share. Now, obviously, it's going to look different. So what we're not evaluating the pessimistic versus the realistic versus the optimistic. We're examining if we think we're going to fall, our EBIT is going to fall in the pessimistic category. What is the best option? Well, in this case, the highest earnings per share is $2.96. So we want to do common stock financing. If we think it's going to be more realistic, average, then our best option would be debt financing, because the highest earnings per share in that category is $4.45. And then if we think that it's going to be more optimistic, we're going to have a higher earnings before interest, the economy is going to get better, etc., etc., then in this situation, debt financing is the best. All right, and so it's going to depend based on which EBIT we're looking at. And so that's where your financial projections come in. And really doing your due diligence to see what the economy is doing, what our sales are doing, how our company is performing, etc. Right. So obviously, the last step within the EPS EBIT is to chart the common stock debt and combo financing on a graph. And you can see that at the center, where they all intersect, is the break-even point, where it doesn't matter which option you choose. So that's just probably like 16,000 maybe. However, you can see that if you're more pessimistic or below the break-even point, then common stock is your best option because it's the highest. And you can see that if you're above the break-even point or above 16,000, then debt financing is going to be best. So that's how you read that graph. So obviously, with everything, there's limitations and considerations that are associated with the EPS EBIT analysis. So you can kind of read through these, I'm not going to read them to you, and they are outlined in table 8.3 of your book. All right. So projected financial statements are also something we need to look at, and this allows an organization to examine the expected results of various actions and approaches. And so basically we say, okay, we're making these assumptions and this is what we think is going to happen, so these are going to be our projected financials. All right, so this is the steps for performing projected financial analysis. I will let you pause here and read this as well as look at it in your text. So what I want to show you here is that here we have up in this top graph what our actual income statement looked like for P&G for 2016 and 2017. And then based on that and based on our projections and all the analysis that we ran here, so looking at our income and balance sheet statements, looking at our cost of goods, looking at our expenses, looking at what our projected net income is, etc., etc. These are the numbers that we came up with. And so you can see what Procter & Gamble did in 16 and 17 and what they projected to do in 18, 19, and 20. So you're assuming here that it's 2017. And so you can see that they're expecting, that their revenues are going to steadily increase. However, you'll notice that their EBIT is actually less and that their net income is actually less. And so you could look and say, well, what's happening here? And here you can see that their operating expenses have gone up for some reason based on. And then this is looking at your projected balance sheet, which looks at your assets, liabilities, and equity. And so you can compare, okay, this is what happened in 16 and 17 actually happened. And then actually we're just going to look at this column where these are what we're projecting to happen in 2018. So you could take a look at that. More cash, more accounts receivables, but we also have more accounts payables, more liabilities, etc. So it just allows you to see where you were and where you're potentially going. Right. The next thing we need to look at is how do we put a value to a company. So there's not an exact science, and there's actually 4 different ways that you can do this. And so those are the net worth method, the net income method, the price earnings ratio method, and the outstanding shares method. And so here is an example of how each of them look. So the net worth method takes your total shareholders' equity minus the sum of your goodwill plus your intangible. Net income method literally takes your net income for the year and times it by 5. The price earnings ratio method takes the stock price divided by earnings per share and times it by your net income. And then the outstanding shares method takes the number of shares that are outstanding or issued and times it by the stock price. And so here you can see that these are the numbers for Procter & Gamble. And you can see that if we do each of these equations, it shows that the net worth method actually shows that they are net worth nothing, which we know is not the case, right? The net income method shows the lease, and then the price earnings ratio method and the outstanding shares method actually come up with the same value. So if we average all 4 of them, we get this total. So depending on which method you use is going to make a big impact on what the value is. Another really important thing in finance is the financial ratios. And financial ratios are looking at things like our current ratio, our quick ratio, total debt to total assets ratio, debt to equity ratio, inventory turnover, return on assets, return on equity. And so the good thing about these is that they all tell us something different, and you can read more about them in your book and learn more about them in your other accounting and finance classes, which you've probably already learned about. But the way that they're used and what you need to understand is that they do change over time. And so you can see here that they actually did change between 16 and 17. And based on performance. They also allow you to compare yourself to others in your industry because there are industry averages. And then if possible, like if your competitors are publicly traded, you'll have access to their ratios or their financial information. And you can actually compare your financial ratios to your competitors to evaluate how you're doing or to benchmark. Right? So the last piece they talk about in this chapter is IPOs and corporate bonds. So IPOs are initial public offerings, and there is when a company goes from being a privately held company to issuing stock or to going public. And so they're selling off a portion of their company to others in order to raise capital. And then some companies often need to make the decision of whether they want to go public or whether they want to stay a private company. There's pros and cons to both. Another option is to issue bonds to raise capital. Bonds are similar to going to a bank and borrowing money, except that the company is getting the funds from investors in the forms of selling them bonds, which they have to pay back, rather than banks. So those are some other ways to raise funds. So that is chapter 8. As always, if you have questions, please contact me. Thanks.